Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is June 25th, 2017 edition of Market Outlook. Well, the first thing I want to note is that we've made some pretty significant changes to the little big view. In fact, we've now upgraded it to big view. So you'll notice that we have some new tabs, moved some things around. We have two versions of big view. This is the free version. There'll also be a premium version, or there is a premium version that covers a whole bunch of new indicators and a broader breadth of them as well. Now, one of the things that we have done as an improvement to the free is we've included some new risk-off, risk-on gauges. And that is all related to a lot of our key ratios and intermarket relationships. So without further ado, let's get into what the markets are telling us this week. Well, first of all, let's take a look at overall performance and volume. So what we have here is a little bit of a disconnect between the outperformance in the NASDAQ 100. It was up 2.24% for the week. The diamonds were down, were basically flat. They were down on Friday 0.17%, but basically flat on the week, and decent performance in the Russell, up a little bit, and the same thing in the S&P. But the key thing to note is this pause and sort of retracement, certainly in the NASDAQ 100, has been accompanied by very little volume. In fact, institutional volume really not present. You can see we've only have one accumulation day in the 3 out of the 4 indices, and none in the NASDAQ, despite the rally over the last 2 weeks. So, of course, we like to see volume on up moves to confirm the market direction. In this case, market definitely price action, overall intact, but a little bit suspect. Let's take a look at a couple of other things here. Okay, let's take a look at the 4 indices in general. And as you can see, our 4 indices, every single indice is in bullish phase. So you can't really argue about overall trend, right? In this case, 200-day, here's your 50. We're definitely paused just under the 10-day moving average in the S&P. Now, what's interesting is that in the NASDAQ 100, we tested that 50-day moving average, bounced off it, and have now moved above the 10-day. This was actually the action based on the close of the big candle bar was very suspect over the last couple of weeks. However, late in the week, NASDAQ cleared that closing price of the big down day, still within the body of the big candle. So I'd like to see some volume to the upside, confirming the improvement. Otherwise, still suspect. Also, IWM definitely improved on Friday, closed over the 10-day moving average, stacked and sloped overall. That's looking pretty good. And right now, the Dow is sitting just around its 10-day moving average, slightly, just slightly on it or at it. What this looks like, a potential flag action for playing a breakout to the upside. So one of the most important ones that you can look at to determine risk on or risk off is the SPY versus utilities. So in this, we have our indicator here, which is our triple play indicator, and that is showing some interesting things. So we got what was an improvement. As you can see, we moved above this black line here, which is our shorter term average of our relationship between SPY and utilities, and that definitely improved on Friday, helping our gauges move up. And as you can see, we were definitely on pause here, and there was a cautionary note. Now, what's interesting is if you compare where we got the signals and how this particular indicator works, it's pretty, it's quite impressive for its ability to pinpoint when to rotate out of stocks and into more conservative instruments. So you can see right here in early or mid-May, we started deteriorating. And when that occurred, it was definitely in the compression zone on utilities. This is just a daily chart on utilities. And at the same time, we had our sell-off here. So utilities continued to move up. You got a nice little pop out of it. And at the same time, you had sort of a mild rise, much lesser percentage type move. Now, we've just reversed, and it's risk back on in terms of stocks versus utilities. Okay? Let's take a look at some other key ratios here. This is a part of our improvement to the free site. You look at these key market relationships, you're going to get a pretty good idea of the appetite for equities across the board. So let's take a look here. This one here is looking at the S&P versus bonds. And as you can see right here, we've lost a lot of strength relative to bonds. Now, this is very interesting, considering that the Fed was, did announce the other and new rate rise, and that it's going to start decreasing its expanded balance sheet. But it has not given a lift to stocks whatsoever. So bonds have been gaining on the S&P. This was also a cautionary note about holding stocks rather than more conservative instruments. Another good risk-off, risk-on indicator is the relationship between high-yield debt and U.S. bonds. And as you can see now, for quite some time, the high-yield debt, which should outperform bonds in a bullish environment, has been steadily deteriorating. So you got a couple of risk-on, risk-off indicators showing caution. Now, a lot of this high-yield debt is related to the oil patch, which clearly is under a lot of pressure with lower oil prices. But nonetheless, over time, this has been another excellent indicator. Another indicator that I like to look at is the S&P versus gold. And that, even though it retraced this week, is nicely intact of favoring the S&P. And another interesting indicator is looking at the relationship between the price of wood, lumber, and gold. And again, lumber is still holding up better than gold. But we're sort of at a cusp in here where all of these indicators could be showing quite a bit of pressure. So when I look at the overall market, there's no question that the trend is intact. But underneath, a lot of these key ratios are telling you to play with a tight stop and with a cautionary tone to it. All right, so now let's take a look at sector summary, because this is really very interesting this week. And in this particular case, what we had, which was surprising, that the semiconductors actually moved back up and had one of the strongest performances out of all the different industry groups. So the 2 or 3 industry groups that led: technology and semiconductors, interrelated, and healthcare exploded with the possibility that there's going to be a repeal of Obamacare. So things have been percolating quite a bit under the hood in XLV and IBB, which is directly related only to biotech. Healthcare is more broad. So in essence, Leading technology, right, up 19% year to date, gained its footing. However, on overall light volume, as we had noted, that the technology sector, the NASDAQ stocks were light in volume and did not have the leadership. But the overall rotation back into semiconductors is a positive. So that is definitely leads to more of the bullish case. But we really want to see it propel out of its current trading range with some more volume. And the other thing, of course, is what is in trouble. Retail and energy continued to have tremendous pressure. So finally, going back to our key indices and charts, let's look at some key levels that you can play against. So the Dow closed down a little bit, as you can see, at 213.37. So what I'd be looking at is a move back above the 10-day moving average and the last couple of days worth of action at the same time. That comes in around 214.50 or so. Now, the key thing to watch, cautionary, is support here at the 50-day moving average and the recent lows. And that comes in just above 137 to 137.20 level. So if we take out these particular lows in here and that 10-day moving average and the 50-day moving average, market would really be in trouble. So that's a really key support level down in here. And again, with this index being under most pressure, the Qs being under most pressure, this is the one I'd look for some real weakness. So strength in the Dow above the last couple of days of action would take us back into a strong acceleration mode. Same thing, potential. You've got a lot of compression, a breakout above the 10-day moving average in IWM. This compression zone in here could definitely power a big move out to the upside. Okay, that's it for now. And by the way, if you have interest in our new premium Big View service with all the other additional tabs and information for a complete global macro top-down view of the world, please feel free to contact us at this page over here. You can get us at by calling us at 973-729-0485 or contacting info@marketgauge.com. Thanks and bye for now.